Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I have two paper money trades for you today on two earnings after the bell. We're going to look at Snowflake and we're going to look at Zoom Video. So, first one, Snowflake. Now, Snowflake, the stock has had a pretty solid run here. It's sitting up or near. It's just only slightly off its recent highs. That will affect the way we trade it. But if you notice something, when we do these earnings plays, we're going to look at and focus on the front expiration, which is that event expiration where that implied volatility is elevated. In this case, we're going to look at a 165 put calendar in Snowflake where we buy the May 30th 165 put, sell the May 23rd 165 put. So that elevated implied volatility in that front expiration, we're selling it. Why? Because the first expiration is 153 implied volatility. The second expiration, the May 30th, is an 84 implied volatility. So buying the lower, selling the higher. Does that mean we're going to be profitable? No, it doesn't. But directionally, this is a bearish play. So buying the 165 call calendar, we have that in for about 90 cents. It's trading right at 90 cents right now. So for under $1, you could put some downside exposure on in Snowflake. Gives you about 2.8 to 3 short deltas. You're collecting a fair amount of theta theoretically on this trade. But again, this is a bearish play in Snowflake. You're looking for a move down towards the 165 strike. The risk on this trade is always the debit paid in a calendar spread. Okay, that's our first trade. Now our second one, Zoom Video. Now, Zoom Video was the darling of the pandemic, as you know. It also has earnings today after the close. So that stock has got a little more favorable chart on it than some other names. So what we looked at there is something in the short put vertical. Now, both of these strikes are going to be in the May 23rd expiration. So so what we looked at is selling the 80.75 put vertical. Now the stock, as you know, is trading $82. So it's a bit inside that expected move of $5. You're selling 115 implied volatility in aggregate. Now let's get into the nuts and bolts of this trade. You are selling a short put vertical. So the max profit is the whatever credit you take in. The risk on the trade, the difference between the strikes, in this case $5, and the credit taken in. So if you take in 130, where this trader right now is trading about 125, 130, the risk is the difference between $5 and the 130. That would be 370 is the risk on this trade. Besides that, it's risk defined, it's collecting theta, and I would say it's not the highest probability, but it's higher. It's a mid to high probability of success. So two trades, a long put calendar in Snowflake and a short put vertical in Zoom Video. That's our show for today, everyone. Have a great day. We'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hincks.